Hashtag the FTX empire. The rise and fall of Sam Bankman-Fried. In 2020, Sam Bankman-Fried appeared out of nowhere. With his messy hair, worn-out t-shirts, and billionaire status, he wasn't just another tech entrepreneur. He was the face of the future. He was the white knight of cryptocurrency, the man who would bridge the gap between volatile crypto and the traditional financial world. He graced the covers of Forbes and Fortune, testified before Congress, and convinced the biggest venture capital firms in the world that he was a generational genius. But while the world was watching the genius, they missed the criminal. At the heart of the empire were two entities: FTX, the exchange, and Alameda Research, his private trading firm. On paper, they were separate, but in reality, they were the same entity, functioning like a black hole. Bankman-Fried was secretly funneling billions of dollars in customer deposits from FTX into Alameda Research to cover bad bets and fuel a lifestyle of luxury on the Bahamas. It was a classic case of a bank stealing from its own depositors to gamble in a casino, all while claiming the house was perfectly balanced. They even created their own token, FTT, and used it as collateral to inflate their balance sheets, effectively printing money out of thin air to borrow against. The end began not with a bang, but with a tweet. When Binance CEO Changpeng Zhao announced he was liquidating his company's FTT holdings, the illusion shattered instantly. The market realized the emperor had no clothes. In just 72 hours, FTX saw a $6 billion withdrawal request, a bank run of unprecedented speed. Bankman-Fried scrambled for $8 billion to plug the hole, but the funds were gone. The money wasn't in a vault. It was incinerated in failed trades and hidden in vanity projects. Behind the curtains, Bankman-Fried hid behind a philosophy he called effective altruism. He told the world he was working to donate his fortune to charity, using this moral high ground to deflect any calls for oversight. He bought politicians, sports teams, and massive advertising campaigns, creating an impenetrable layer of legitimacy. While he preached ethics, his inner circle was busy buying multimillion-dollar real estate with customer funds and hiding their tracks behind encrypted messaging apps. It wasn't just a business failure. It was a cold, calculated theft. The collapse of FTX was the day crypto grew up, but it paid a brutal price. When the dust settled, $32 billion in value had evaporated, and thousands of ordinary people saw their life savings vanish overnight. Proved that in this industry, trust is a liability. Charisma is not a substitute for an audit, and no matter how genius a founder claims to be, if you don't hold the keys to your own assets, they aren't yours. The story of FTX is a brutal reminder that the greatest risks aren't found on the price chart. They are found in the people running the exchange. Today, the industry is still recovering from the wreckage, but the lesson is written in stone. If a platform promises returns that seem too good to be true, you aren't the investor. You are the liquidity. I've compiled a comprehensive guide on how to audit these exchanges and keep your capital off the chopping block. The link to my private Telegram is in the description. Join us, and let's stop gambling and start protecting what's yours.